Oh man, the tax benefits of borrowing from your 401k. Man, I've been thinking about a video like this for years. My man Shannon had written me, he said, Josh, is it worth borrowing against my 401k to buy a vehicle? I wrote him back, said, what's the interest rate on the 401k loan? 9.25. And I said, ooh, ooh, that's interesting. That is very sexy to me. I'm like, that is interesting. All right, so, man, so I'm just in the back of my mind, I'm thinking, so we're not going to talk about vehicle loan here. There is value there for sure, borrowing against your 401k for a vehicle loan. But I've always wondered, I said, isn't there a tax benefit by pulling money out of your 401k in advance of required distributions or advance of separate your service and while you're still working and paying the money back? And there is, and I'm going to share with you here. And by all means, try to pick a hole in this. It's great. I love it. I love this stuff. That's why you come here, man. If these videos help you, and I'm talking about stuff no one else is, a cup of coffee, dudes. Buy me a cup of coffee. Link will be in the show notes. So unlike my engineer clients and friends, talked to a chemical engineer yesterday, I need a good old piece of paper and my pen, paper, pencil, or whatever, and my my Texas Instruments BA2. I need that. My engineer guys, they all have spreadsheets coming out their wires. I'm like, I get that. I like spreadsheets too, but something in my head says I got to sit down and write it out. So here's what I've come up with. Look at this. Oh man, this is a thing of freaking beauty. This is a thing of beauty. All right. So we're not talking about a car loan here. We're just talking about borrowing from your 401k. Is there a tax benefit in doing this? And the answer is yes. I'm going to show you. So we got Shannon here, and I didn't tell him to do this. It's just something I've been thinking about, and we're going to use him as a name because he emailed me to make me interested in this. He's got $100,000 in his 401k. He's got two options. One is he can let that money sit there and just grow. We're going to assume a 5% rate of return on his investments, okay? So we're just going to sit there and say you got 5% rate of return on investments, and we're going to look at this over the course of 5 years. So he could just sit there, let that money grow at 5% a year, or he could borrow $50,000 of it. Now again, the reason we're doing 50 is because with the CARES Act, they changed the 401k rules and whatnot. I think that's been rescinded. I think we're back to what it was, which the max you can borrow from your 401k is $50,000 or 50% of your vested account balance, which is the lowest of the two. So if you got $150,000 in your 401k, all vested, the max you could borrow is $50,000. If you got $50,000 in your 401k, all vested, the max you could borrow is $25,000. Remember that. And I might be wrong here. I don't think I am, but I could be. That's fine. Just put it in the notes. The max you can borrow is 50% of your vested account balance, or $50,000, whichever is less. So in this case, my man Shannon's got $100,000, so we know he can borrow 50%, or that'd be $50,000. It just happens to be the same. I just like nice round numbers. So if he were to borrow against his 401k, all right, we're going to amortize that over basically 60 payments. N would be 60. Now, if you're in a company like when I was at USA, my N would be 120 because we got paid twice a month. In this case, we're just for simplistic going to say he gets paid once a month, all right? So he's going to get an interest rate, which he pays to himself, a 9.25. He's going to pay it back over 60 payments, all right? So when he amortizes his loan, it'll be $1,043 a month will be his monthly payment, which means at the end of 60 payments, there'll be no more debt due to himself. That makes sense? So we got $50,000 as our present value, 0 as our future value, interest rate is 9.25. We're amortizing it over 60 payments. That means our payment is $1,043. At the end of 5 years, no more payments, nothing, no fuss, no muss. Now, that $1,043 he's paying is also growing at 5% a year. All right, so he's paying $1,043. If we times that by 60, that's about what, 63,000, 62,000 or something like that. And the amount of money he's actually putting back into his 401k. All right, so he's borrowing. He took $50,000 out. He put it over here. He's paying $1,043 every month for 60 months, and that $1,043 is also growing at 5%. So when all is said and done, at the end of 60 payments, he'll have $70,930 in his that he put back into his 401k. Took out $50,000, put back in $70,000. He put back in $62,000. He got some interest on that $62,000 as well. So he'll have basically $71,000 in his 401k, but after borrowing $50,000. Everybody with me on that? That's pretty common sense, I think. But I mean, poke holes in it. But he still has $50,000 that's still sitting there. Now we're not contributing to this $50,000. It's just growing at a simple 5% interest rate, or compounded 5% interest rate. But when I mean simple, he's not adding to it because his payments are going to pay back his 401k. So this $50,000 is just sitting there, growing each and every year at 5% a year. So $50,000 is present value, interest rate's 5%. Number of it's no payments, but we're still using 60 as our N to make it equivalent for this. There's no payment, doesn't matter, but in this case we want to keep everything even Steven. His payment 0. His future value on that $50,000 at 5% a year will be $64,167. All right. So he added back into his account with his payments from the amount he borrowed, $70,000. He added the amount that was left over in his 401k, the $50,000 that was still sitting there, growing at 5% a year, is worth $64,000. All right, so far so good. So we combine these two. We combine number 1 with number 2. That equals $135,000. All right. Now let's just say he just said, you know something, Josh, I'm going to pull the whole thing out all in one fell swoop. I'm going to pull $135,000 out. We'll just essentially give him an effective 15% tax rate. So he'll be left with $114,832 on that amount of money when he just pulls it out in one fell swoop. Everybody with me? But don't forget, he still has this $50,000 he borrowed. He parked that over in VTI. We'll just use VTI for example. But that is not taxable other than the interest, the dividend income that VTI produces, which isn't much. VTI, there isn't much dividend interest, but we're still going to show it here because I want to show this how beneficial this strategy could be. So $50,000 is growing at 5% a year, just like the other $50,000 that was still in his 401k. All right, so he's got $50,000 in his 401k, $50,000 in a brokerage account in VTI. It's also growing at 5% a year. It's growing, not making any contributions. It's growing at for 5 years. That will be worth $64,167. Now, because VTI and the way that Vanguard's ETFs work, there are no capital gains there. That could change, but right now it's not. There's a dividend. We'll give him a small dividend of about 2% a year. So he's basically losing about $200 a year in taxes on the dividends he has to pay. And we're going to say he's in a 15% dividend. And because he's in a 15% effective marginal tax bracket, he will have to pay tax on those dividends. We're just using that for example. Anyway, that's a side note. And I'm not even using the dividend income that generates to add to the portfolio or anything. I don't even want to do that. But we could, and it'd make it even more beneficial. So that's $64,000 because it's tax-free because he already paid tax on that. How did he already pay tax on it? When he borrowed from his 401k. His contributions back to his 401k are post-tax. We'll talk about that here in just a second. But that $50,000 grew to $64,167 tax-free. All right, again, capital gain tax. If he were to sell it, there'd be a capital gain tax in terms of the proceeds of the sale. But we don't want to do that necessarily. We just want that money sitting there growing at a clip, and there's no capital gain tax inside the VTI. But you could sell it for a capital gain, but we don't want to do that. That right now is worth $179,000. So every $179,000. When all is said and done, he's got about $179,000 in his, of which $114 is in his 401k, $64,000 is in a brokerage account. Again, could there be tax on the brokerage account? Yes. It'd be the difference between this right here, $64,167, the amount he borrowed at the capital gain tax rate. But again, we don't want to necessarily have the capital gain tax rate. Why? Because we want to leave that to our kids tax flipping free as a step up in basis. I hope that makes sense. That'd be the benefit. Now, if he does have some capital gain tax, he will have to pay $14,000 at 15%, whatever that is. So that's roughly $2,000 of capital gain tax. But remember, this money is now outside of the IRA. Yeah. Now, on the other hand, if he just left $100,000 in his 401k, he's still making a monthly payment of $1,043. We want to have these even. All right, so he's got 5 years at $100,000. He's adding $1,043 a month for 60 months. His future value is $199. But we're going to say he has to pay 15% tax on it. We're trying to make this as clear as possible across the board, man. Even Steven across the board. We're not trying to juice anything either way. So in this case, 199, again, 100,000 bucks at 5% a year interest with a 1,043 payment over 60 payments screwed to $199,000. Minus 15% tax, he's going to do again a 1%, he's going to pull the whole thing out in one fell swoop. He's left with 169, all right? So right here, he's left with 178, here he's left with 169. You're thinking, well, this is definitely better. Not necessarily. Because don't forget, he gets a tax deduction on the 1,043 he's putting in. All right, so the government, because it's pre-tax, when you're borrowing from your 401k, it's post-tax. When you're putting money into your 401k pre-tax, that is money you don't pay tax on. So in this case, he's receiving pre-tax $1,043 a month times 12 at a 15% tax bracket is the equivalent of about $1,800 a year in tax savings. All right, so that $1,800 a year in tax savings, that's our annual payment over 5 years at a 5% interest rate. It gives us $9,400 of future value. And again, that would be, I guess without the tax savings, that would be tax-free as well because it would be a brokerage account for sure. So now at the end of the day, he's put $2,000 a year roughly into a brokerage account for 5 years at 5% interest rate. That'd be worth $9,400. So $9,466 plus the net result of pulling the whole thing out in one fell swoop, he's sitting on $178,841. Here he's sitting on $178,999. Again, the only difference would be the capital gain if he were to sell these right here. All right, that's more than offset by the portfolio decline, essentially, that could be happening inside your 401k if the markets go south. I can't stress this enough. Here, now he could get the same decline in this account, don't get me wrong. There's something else to think about. But if the portfolio were to, and both sides is going to be pretty much equivalent, don't get me wrong. But because if the portfolio declines, because this money is out, he's adding back to it at $1,043 a month. Ooh, that means he's putting shares back on the cheap. Now you can make the same argument here. I mean, the arguments are pretty even, Steven. But from your own thought process, I mean, so literally, this was almost a wash. Except for what? If you did not take this out in one fell swoop here, if you just let those puppies keep growing and growing. Well, here, this keeps growing and growing. Tax as long-term capital gain, the amount of this above the amount of that, this would grow as ordinary income, and this grows at ordinary income. I'm just trying to show you that if you were to do this right now, it's basically even in terms of the tax benefits after 5 years and pulling the thing out in one lump sum. However, as that money continues to accumulate, more money is accumulating in a tax-efficient portfolio, long-term capital gain and dividend tax, as opposed to a tax-inefficient portfolio, which is pre-tax. I hope that makes sense. That's a big deal. And we're talking 10, 15, 20 years from now. This right here, I mean, you could have easily a couple $100,000 in there, and basically tax-free. Because long-term capital gains aren't taxed in VTI, you have some dividends to pay. So let's say it's $200,000, a 3% dividend, $6,000 a year of dividend tax. Whoop-de flip and do. If you're in a 12% tax bracket, it's not taxed anyway. Isn't that crazy? Now the drawbacks, again, would be that you're putting money in after tax. We've already accounted for that right here. But on top of that, if you were to leave your job before 5 years, this would be subject to total income tax right out the gate, whatever you haven't paid back. So let's say you left in 2 years, you still had a $35,000 balance on that 401k. You're gonna have to pay $35,000 of that $35,000 will be taxed as ordinary income, and if you're under the age of 59 and a half, there'll be a 10% penalty as well. That is risk. I do not deny that in the least. But I'm telling you though, man, the risk on here is that grows tax-free. I say tax-free because it's not literally tax-free, but pretty doggone close. Tax preferable. That's all there is to it. Taxed, the least taxable here and here, because it's taxed as ordinary income when it comes out. This is taxed as preference. Qualified dividends, long-term capital gains. On top of the step-up in basis to your kids. Dude, freaking great strategy, man. Should you do it? I'm not telling you what to do. You think what you got to do. At the end of the day, it matters not what the interest rates. This right here is a big deal. This right here, this right here, this right here is all the same. Interest rates 5% of board across the board. I'm just trying to make it, again, as clean as possible without trying to goose this one way or the other. Does it jump out at me like, man, it's definitive? No. Not like paying off a credit card or something like that. But man, there is some strategies there, tax advantages for borrowing from your 401k, especially in this market where you're paying yourself 9.25% to your bank, not to Jamie Dimon, not to SVB. You're paying back to yourself. There's a benefit there. Now, what happens? Everyone's going to say, yeah, but most people just spend that money. Yeah, well, don't do that. If you're going to spend that $50,000 on a new freaking surfboard, then yeah, don't do that. There is a benefit to having your 401k with some restrictions on your ability to have access to it. But if you're going to use it in an investment perspective, I just showed you right here. It's basically a wash, tax consequence, net of taxes right here. But there's some benefits as well in the future as you let this guy grow. This will grow with a huge albatross on its back, as will this, but not this right here. That's the money that you borrow, that you put in VTI, that's just growing to the moon and beyond. Love to hear your thoughts. We'll see you guys. And again, pick it apart. Love to hear your thoughts.